Mr. Durukar says that he is confused between equity, balanced and debt funds. He asks if he could explain the difference between them and tell him which ones are best suited for him.
Uh, Equity, balanced and debt funds are, the name itself is quite self-explanatory. Equity funds invest in shares, debt funds invest in bonds and, variety of bonds. Equity funds invest in a variety of shares, and balanced funds invest in a variety of bonds as well as shares. Uh, but the balanced fund, the popularly referred balanced fund, they have a 70% allocation to equity, 30% allocation to fixed income, generally speaking. And that is why the tax treatment, the returns or the gains from balanced fund is treated as equity, because that is what our tax laws stipulate. For investment to be treated as equity in a mutual fund, it must have an allocation of 65% and more in equity at all times. That is what these balanced funds do. So balanced fund is a great way to have a equity heavy portfolio with reasonable stability and the tax treatment of equity and all equity investment. Equity is a diversified portfolio of shares, and and fixed income funds, as you understand, and then there are variety of equity fund, variety of balanced fund, and variety of debt funds. Debt funds are primarily, the variety of debt funds you should choose depends entirely on your investment time frame. Money for few days, consider a liquid fund. Money for few weeks, consider a ultra short term bond fund, so on and so forth. So you have, the short term debt fund, or the income fund, or the dynamic income fund. They are the variants of that. So longer the time frame, or if you are looking for a defined time frame, consider a fixed maturity plan, that they give you a reasonably predictable return for a defined time period, for a fixed time horizon. They are equivalent of a fixed deposit in the shape of a mutual fund. So sometimes they can be more tax efficient. I think tax efficiency of a long term bond hold fixed income fund is very interesting if you are a very conservative investor. Balanced fund is a good vehicle for long-term equity-oriented investment. If you are a scared, if you are a conservative investor, if you have never invested in the past in any market-linked investment, so it's a good way to start, because they are not as volatile as an all-equity fund. And then there are different kind of equity fund. The large cap funds invest in larger companies, big companies. Mid cap funds actually invest in mid-sized companies, and smaller companies funds invest in small cap funds invest in small companies. And yeah, their characteristic changes because the small companies fund are very volatile. Mid-sized companies can also be volatile, but far less than a small cap fund. Or large cap funds tend to be relatively more stable, predictable, and balanced fund, as I explained you. But it's hard to suggest any fund, because these are the variety of funds. But basic thumb rule to follow is that money which you need in a predictable time frame, in 3-4 years time frame, and that money should be invested in fixed income fund. Money which you are unlikely to need in foreseeable future, 5 years and more, you should consider some equity oriented investment, because they tend to optimize your return. You should never consider investing your short term money into equity, because it can actually it can give negative surprises. Equities, shares, investing in an equity fund could be very risky if you are investing for the short term, because equities do very well over a long period of time, but short period of time they could be extremely disappointing, and markets correct, it could be very turbulent. So these are basic rules to follow, and keep listening to these hangout sessions. Hang out with us, and you'll learn more and have the confidence to get started more confidently.